Hello, I'm Mary Reed, National Director of Qualified Plan Marketing for Alliance Benefit Group Pentegra. We are a third-party administrator of qualified plans and currently administer about 3,500 plans. Our parent company, Pentegra Services, Inc., has been in the pension business for nearly 70 years. Together, our expertise and talented staff helps find solutions for clients. Welcome to our training series for financial professionals. In this series, we will use our expertise to help prepare you to find prospects and write qualified plans from closing to establishing the plan and further administration. Let's begin. Hello, and welcome to our session on cash balance plans. I know I've been getting asked a lot of questions about cash balance plans and what they are and how do they actually work. Well, a cash balance is a hybrid plan. It's really a defined benefit plan at its root. So all the defined benefit rules apply. That means there's no $50,000 account limit for contribution. There is the benefit limit that applies to defined benefit plans, but the contribution can be whatever is needed to fund that. And so the investments are pooled like any defined benefit plan. So it's subject to all the rules that defined benefit plans are subject to. But where it's different and what makes it a hybrid is that the accounts it has accounts that look like a defined contribution plan. Now, how can that be? Well, what those accounts are, that's really how the benefit is defined. In a traditional defined benefit plan, you'll always see a benefit formula that's something like, you'll receive a benefit of 20% of pay when you're age 65. Well, instead here, the benefit is defined as an annual contribution credit, and there are also annual interest credits. The combination of those contribution credits and interest credits is what your benefit is at the time that you leave. So from the employee's point of view, it looks like a defined contribution plan. But those accounts and those credits are on paper. The money that stands behind them is really in a pooled account being managed by the plan trustees, and the actuary is actually computing each year what the promised benefits are versus what the current plan assets are, and telling that employer what they have to contribute to make sure that plan is properly funded. So why are they so popular? Because they've really gained popularity in the last few years. They can be less expensive than a traditional defined benefit plan. They can give more control for the employer to choose who is going to get how much money when that plan is designed. The employees find them kind of easier to understand, and it's more immediate. Instead of knowing, I have no idea if I'm a 35-year-old participant in a traditional defined benefit plan, what my lump sum might be worth way down the line, or what that might be worth to me if I leave tomorrow. Here, I always know what my account balance is. There's not that projection and then computing back, so it's easier to understand. These plans can also include life insurance, just like any other qualified plan. They would be under the rules of defined benefit plans, since that's what rules here. So who is a potential candidate? These are working very well. I would say the sweet spot is companies with 5 to 50 employees. I certainly have seen them in larger companies, but most of the plans in the closely held business market that I've seen are companies less than 50 employees. I would say the exception to that is I've seen a couple of medical practices that are very large, 200, 250 employees who have adopted cash balance plans because they had a large number of doctors who were owners there who really benefited from this. Typically, the business owner is seeking to receive more than $50,000, which is what they could get if they did it as a profit-sharing plan. And they also work well where we have owners or key employees who are of varying ages because we can steer the money a little bit better here. If you know where profit sharing, where a new comparability profit sharing plan will typically work, these work in the same kind of scenarios but with much larger numbers. And they also work extremely well as a carve out, which I will show you an example. They work in combination, and this is how most of them are being adopted, where they're done in combination with a 401k plan. We carve out, put into the cash balance plan the employees that employer wants to benefit the most. The rest of the employees go into the 401k plan. The plans are tested together and treated for testing purposes as if they're one, and it gives some very good play with the numbers. Not only us, but that's how most of these plans are being adopted. So let's just go over some of the basics some more. It is a defined benefit plan. We're on slide 5 here. That means you do require an actuary They will do valuations every year, and they do have to sign a Schedule B that goes along with the 5,500. The funding deduction rules apply just like they do to any defined benefit plan. These plans are subject to PBGC just like a regular defined benefit plan. As I said, the investments are all pooled. There are no actual accounts. The investment of the assets is pooled and controlled by whoever the trustee, either the trustee or whoever they've assigned for that risk. They're not directed by the employees. The benefit that that employee will receive is made up of the hypothetical contribution credits and interest credits. There is no limit to $50,000. And typically the participants will receive annual statements which will show the value of that account so they know how much their benefit is worth. You can have what are called multiple benefit structures, and that's typical in these plans where you divide your employees into different classes with each class getting a different contribution credit rate. It's a way of steering the money the way the employer might want to favor certain employees more than others. Now the benefit, at termination, the participant, assuming they're vested, would typically receive the present value of the hypothetical account balance. In other words, you don't have to convert it back. They'll receive their account balance. These plans are subject to 3-year vesting. You cannot go longer than that. You have to use 3-year vesting. Now, what is the contribution credit? Well, usually the contribution credit is defined as a percentage of pay. And typically the goal is to provide the maximum benefit to the owners or the highly compensated employees and give a lower contribution credit to the rank and file employees. So typically when these plans are designed, the designer will focus in on who wants to get the most and then kind of back into what has to be given to the rest of the employees. Demographics are very important. Have to pass non-discrimination tests here. Age is a factor, so the plan will favor anyone who's older. So ideally, you would want a group that has older owner or owners and younger employees. If there's a mix, that can be handled to some degree, but this is not a great design for an where you have an owner of the business maybe who's 35 and they have employees whose ages are all over the place, including in the 50s. That probably wouldn't work very well. The interest credit that is given is typically a market rate of interest, so it will fluctuate from year to year. And so it's not a fixed amount. It typically is a market rate based upon an index. All right, so what's the big attraction here? The big attraction is all about control. I'm on slide 9 here. It's all about giving what you want to who you want. And this is a plan that can do that very well. We already talked about the funding. Again, you need the enrolled actuary pooled fund. Keep in mind any investment loss here is guaranteed by the employer. If the funds, wherever they had them invested, lose money, they will have to contribute more next year. That risk is with the employer. Unlike where employees are used to seeing an individual account, like a 401k plan, where they're bearing the investment risk. All right, so let's take a look at a sample company to try and get a better idea of how this works. We have a company here with 2 owners, ages 55 and 50, both making $250,000. And then we've got 6 employees, ranging from age 37 to 57. This is a pretty good candidate. Typically, we want our owners within 10 to 15 years of retirement to get those high numbers for them. Few and younger, preferably employees. They're almost all younger here, except for one. Well-established business with a strong, stable profit history so they can keep up with ongoing contributions and looking to put away more than the 25% they could otherwise do in a profit-sharing plan. Now you can see on slide 12 here, the way this plan gets designed, these are the contribution credit amounts. We have divided the employees into 5 classes, each getting a different percentage of pay. That will be their contribution credit percentage. Here are the numbers for that. Owner A will get a contribution credit each year of $140,875. Owner B's is lower because they were younger, $89,474. Now, if they were not happy with that disparity, we could cut Owner A back to match Owner B, but we could not get Owner B's number up to Owner A because of the actuarial calculations. Now, you can see where everybody else falls in here. There are 2 employees who are not coming out really well here. The office manager is getting $16,720, and the receptionist $21,900 because they were older. That receptionist was 57. We can't change someone's age. So that's the credits that each person would be getting assigned. Now the confusion for most people here is that the contribution credits are not the same as the actual plan contribution. Well, how could that be? because the credits are defined in the plan document. That formula, those formulas, each percentage that each group is getting is defined in the plan document, and that's what they will get. But from an actuarial's point of view, what the actuary is doing is projecting the accumulation of those benefits out to a future retirement date that's defined by the plan, 62, 65, and then computing back using an interest rate to say, okay, how much money do we actually have to put in the plan today to make sure we'll be able to pay that benefit that accumulates at that retirement age. And so they calculate back, and you can see here the credits are $286,504, but the contribution that the employer will make to this plan is $257,253. That's because time is a factor here, and we're projecting forward and computing back. This is confusing to employers, but it is accurate. I will also tell you, if you see here the first year, the minimum and the maximum are the same. A minimum and maximum contribution amount will be given to that employer each year. It may change over time. The first year will always be the same number. And it should stay fairly steady unless some really extraordinary changes occur, either changes in the group of employees or a tremendous market loss, for example, or market gain on the investments that was not anticipated. You could add life insurance to this plan. Like any other defined benefit plan, it will increase the cost somewhat, nothing like the premium, but some fraction of that. It would raise the minimum and the maximum as well. I can tell you when you do insurance, the way the numbers work, they would not be exactly the same numbers the first year. You would get a range of contribution, and the minimum would be a bit higher than here. The maximum would be quite a bit higher. Now, the way that most of these plans are actually being put into place, as I said, is in conjunction with a 401k, and you can see that here on slide 15. We keep both our owners in the cash balance, and we have to have here, to pass our coverage rules, we have to have one other employee, so we've brought the office manager in. The office manager is getting a contribution credit of $4,760. And you can see our costs there in the next column. That's the actual actuarial cost. But then we also have the 401k. Now, both our owners defer. All the other employees can defer also. Both our owners get their catch-up because of their age. We don't know what the other employees defer, and frankly, it doesn't matter. We hope they will, but they don't have to. It doesn't affect the employer's cost. The employer's cost is covered by making this a safe harbor 401k, so we know they're putting in 3% for all the employees, and then a profit-sharing plan at whatever level is needed to pass our testing. The actuaries figure that out, and you can see what we end up is the total column here. Owner A gets $163,375 each year. Owner B, $111,974. And you can see each employee, $6,000, $5,500, $5,200. The only one who's higher is the office manager because that office manager is in both plans. And the receptionist is now down to getting $3,000. Now you can see if we had done the cash balance only, which are the numbers all the way over there in the white to the right, the owner would have only gotten $140,000 and $89,000 for the second owner. But look down to the office manager and the receptionist. They would have gotten $16,720 for the office manager and $21,900. Those are the contribution credits. If we had done cash balance only. By combining the two plans, those numbers were reduced significantly, and the two owners' numbers went up significantly. That's what most business owners like to see, and that's what makes them like these plans. So again, here's our candidate. 5 to 50 is the sweet spot, but as I said, I've seen them with plans as large as 250 employees, especially when we do those carve-out arrangements. Looking to get more than that 50,000. Hopefully older owners and younger employees. If they have a new comparability plan and we know that's working for them, but they'd like more money, this may be a very good combination to layer on top or put in place. Again, often in combination with that 401k is where it's going to work. So what's happening now with cash balance plans? Just to give you an idea of what's going on out there in the marketplace. These are statistics from a year or two ago. Of the plans that are being installed, 80% of cash balance plans right now are being placed at firms with less than 100 employees. There's the sweet spot. 63% of the plans have fewer than 36 participants. 79% of cash balance plans are combined with a profit sharing or 401k. That's the scenario I just showed you. Medical and dental groups account for 34% of the plans. California and New York are leading the way. with 26% of all the plans installed. So my point of showing you all this is to let you know that if you haven't seen a cash balance plan yet, you will. You will run across from them, and you have a great opportunity here to put this in front of your clients and prospects and your CPAs that you work with as a new, innovative plan solution that may work for employers where traditional plans had not worked in the past. So it's a great opportunity, some great business ahead. Call us if we can help you. We're always free to you and the business owners, and we love to help you. So please give us a call. Thank you. If you'd like additional information, please visit our website at abgpentegra.com. You can also reach me via email at mread, that's R-E-A-D, like you read a book, at abgpentegra.com, or you can call me at 802-477-2018. Thank you.